Hi everyone, financial statement analysis. So at this point, you have done all the financial statements. You did your 4 major financial statements. You just finished the statement of cash flows, but now it's time to look at them, right? We've produced them, but what does it mean? Or is a company liquid enough to pay its bills? Does it use its assets efficiently? Does it look like it's going to continue to grow? Is it on a nice upward trend? One of the major things is predictability with the financial statements and financial analysis tools, right? What investors want to see is they want to see a nice predictable incline on overall growth and income and all of those good things. So now we're going to take some time to look at some of the tools in this chapter for financial statement analysis. So one of the things we're going to be doing, and this isn't going to age well, it's already, past this time period, but I was trying to do non-pandemic time periods. So we're looking at 2017, 2018, and 2019. The pandemic, everybody's numbers are crazy about everything. So it's just, they're difficult to use for this tool because there was nothing predictable in the last, bunch of years the last few years about that. So anyway, point being is we're going to be looking at 2017, 2018, 2019 of the Home Depot and Lowe's. Those are going to be our two items. Two businesses that we're going to compare with our financial analysis tools. All right, so looking at this, you might see consolidated statements of earnings, and you might be like, we didn't do that one. Well, statements of earnings is the same basic thing as the income statement, okay? They just have slightly different names sometimes, but it's an income statement for all intents and purposes. Okay, so, you start off, and notice it's fiscal year, and these numbers are all in millions, right? So I might say 110,000, but net sales certainly wasn't 110,000. It's 100, add 3 more zeros to the end of all these numbers. But they become burdensome, so companies very often cut off the millions piece of it. All right, so we still start off the same way. It's a fiscal year, meaning not a calendar year, not January through December. I actually don't know what their fiscal year is, but it could be anything, right? Any 12-month period. But you have net sales minus cost of sales, which is basically the same thing as cost of goods sold, gives you gross profit, right? As far as I'm concerned, gross profit is one of the most important numbers on this income statement. The idea is that this is the cost of the products that I'm making and I'm selling, right? Or this cost of the products I've purchased and I'm selling. I have, if I'm Home Depot, I've had $72,000 worth of products it cost me to purchase them, and I'm selling them for $110, right? That's the markup on them. So at the end of the day, on every sale, on all the sales, I've made $37,000. Okay, remember million, but $37,000. And from there, we subtract operating expenses, right? So those, the selling, administrative expenses, all of the costs of selling, right, and running your business are operating expenses. Total operating expenses are $21,000, and that gives you, again, what I argue is the second most important number, or probably actually more important than the gross profit, but is the operating income number. The operating income number tells you, did I make money doing whatever it is I do in my business? All right, so that's where that operating income number is really important. All right, so there we go. Moving along. From there, we subtract out our other items. It could be a plus, it could be a minus, minus other interest, plus other, plus investment income, minus interest, and so on. But it's an expense, so it's listed as minus. It's counterintuitive, but you get the idea. All right. That gives us earning before income taxes, right? Income taxes tends to be broken out as a separate line because that's really not necessarily part of operations, and everybody's got to pay them, so they tend to get broken out rather than being mushed into all of these other numbers. Income tax expenses is one of those items that gets broken out. All right, and from there that gives you net earnings, which is basically net income. All right, so just one thing to note, and we're going to get to earnings per share, but to note, earnings per share is the only financial analysis calculation that's required to show up on the financial statements. You've got basic earnings per share and diluted earnings per share. We'll spend some time talking about basic earnings per share, but diluted earnings per share is a whole nother conversation. Okay. Ooh, dog dropped the ball down the stairs. I don't know if you can hear that. Okay, so we've got Home Depot's balance sheets, right? They're consolidated balance sheets for 2 years. They've got side by side. So the golden rule, assets equal liabilities, plus stockholders' equity. So 51,000 total assets, 51,000 down here, right? These should match for sure, because that's the accounting equation, right? Assets equal liabilities plus stockholders' equity, and they have them all kind of listed together here. Well, these are the liability items. There are current liabilities, long-term liabilities, and here's all of your stockholders' equity items. All right, so let's talk about this. Home Depot, what do? They put the financial statements out for the investors and the creditors, right? They produce them. It's a summation of how they did during the year. It's reporting historical data, and they're giving it to the investors and creditors. And the whole idea is that it needs to, they're built for predictability in the sense of these are all things that happened in the past. You're trying to predict the future, whether or not to invest with them, based on those financial statements. Now, the financial statements are audited by the CPA firms. Big public companies, public companies all are required to be audited before they produce their financial statements out to the world. The idea being that the auditors are protecting the investors and the creditors, right? That's their whole job. They're protecting them by auditing the financial statements. Home Depot pays the auditors. Now that sounds like a bad thing, but it's not, right? Because Home Depot is kind of paying the auditors to render an opinion on whether or not the financial statements are produced fairly. Meaning, are they following GAAP practices? Or do they, calculate their receivables properly? Do they have, do they pay their bills and report them properly? Are they following GAAP? That's what it comes down to. So the auditors come in and they kind of spot check items just to make sure. They look at the processes and so on. And their job is to say, yes, these financial statements can be relied upon because it looks like Home Depot is following GAAP. And here's what that kind of looks like. It's a report of the independent accounting firm. Actually, there's been some changes to this from what I heard in the last year or so. But so you get an opinion on the consolidated financial statements. They give an opinion. That's what the accountants do. They say, we have audited the consolidated balance sheets, blah, 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 of the company for the time period. It says, in our opinion, the consolidated statements, there we go, in our opinion, that's the opinion part, the consolidated financial statements present fairly in all material respects, right, material being the important things, the financial position of the company. Okay, and here we go, for the time period, it says in conformity with U.S. generally accepted accounting principles. Okay, so they're following GAAP, and that's really what the test is about. There are a couple other types of opinions on the financial statements. This is what's called the clean opinion or the unqualified opinion. Now, unqualified sounds like a bad thing, right? People are unqualified. It means they're not good at their job. That's not what this means. If you think about what a qualified statement is, or a qualifier, it means everything is good except for this one item. That's when you say you qualify a statement. So unqualified means there's no buts or no ors. We're just saying they're good, they're clean. This is the unqualified opinion, no issues to speak of. That's what that basically means. And they've expressed an unqualified opinion on the effectiveness of the internal control over financial reporting. Okay, and you see at the bottom here, this is one of the big fours. There's four massive accounting firms in the world. Let's see if I can do this. KPMG, PwC, Deloitte, and EY. Okay, they sound like they're a whole bunch of letters. It's because there are a whole bunch of firms merged together. Like EY was Ernst & Young, and that was a combination of Ernst & and Arthur Young got combined to be Ernst & Young, EY. KPMG, I can't even pretend KPMG, let me see. I know it's something Pete Marwick, and the idea is that they're letters because there's so many combinations, but there's four massive accounting firms in the world, and those are the ones that tend to be the main auditors for larger companies, like the larger public companies like this one. And this is them stamping their approval, saying we are KPMG and we did all these things and you can rely on them. Okay, so Lowe's has its own set of financial statements. We're going to be looking back to these as we go along. And, they say their fiscal year ends January 31st, 2020, which basically means 11 months of that were in 2019. So when we're comparing year to year, we're going to be using that data to be the 2019 data. Okay, so, too far. Okay, and we've got the balance sheets for Lowe's, same idea, right? You've got liabilities and stockholders' equity, matching liabilities and stockholders' equity. Okay, so back to this for a second. Here we go. All right, we're going to, like I said, we're going to be grabbing all of this information. That's the income statement for Home Depot. All right, so one of the basic analytical procedures is a horizontal and a vertical analysis. A horizontal analysis tells you the trend of one account over time. A vertical analysis shows the relationship of different accounts to one key account. Okay, don't worry, we'll get into examples on this. If you're looking at the income statement for vertical analysis, sales is your one key account. If you're doing it for balance sheet, total assets is your one account. Okay, so what a horizontal analysis will tell you, and we're getting close to the 10-minute mark, so I will cut it off shortly. Horizontal analysis will say sales grew by 20%. Sales, expenses declined by 5%. That's what we're looking at for horizontal analysis. I'm going to show you how to calculate that. So if we grab the numbers from the financial statements, here's Home Depot, right? Oops. Hang on. We need net sales, we need gross profit, we need net earnings, right? So here it is. We're going to grab net sales, 110 from this year, 108 from last year. We're going to throw those in there. And what the formula is that you're seeing here is actually, I don't have it written down, let me write it in here real quick, is current, oh, come on pen. Oh, it does not like that. Hang on, let me go back a second. All right. Oop, too far. There we go. Pen. Okay. It doesn't want me to write with a pen. All right. Current. My goodness. Turn the pen on. We'll do that. And we'll change the ink color. It's current year minus last year over last year. That's the calculation for all this horizontal analysis. Current year minus last year over last year. So looking at the data, 110 to 108, 203. And now it doesn't want me to click. All right, you're looking at 1.9%. Now if we did the same thing, current year minus last year over last year, we put those same numbers in there, and our profit has increased by 1.1%. So good for us, good for Home Depot, right? They went from 1.9 to 1.9%, an increase in their sales, which when you're looking at the numbers they're looking at, that's a pretty big increase in sales. And then they were able to keep most of that increase in sales by keeping more than 1% of that in gross profit, because their cost of goods sold must have gone up as well. Your net earnings overall, if we grab those numbers, went up by 1.1%. So not only were they able to make increased sales, they were able to hold on to that increase. They didn't like spend it all in expenses. They were able to kind of carry that through. Now, if you look at that in comparison with Lowe's, they did not do those well. They had an increase in sales too, but their profit, they weren't able to hold on to it. They must have increased their expenses significantly as well for their profit to have gone down so much. But their net earnings was up 85%. Now, we'll get to why that's a little crazy in a minute. So now if you went through in 2017, 2018 numbers, here's the 2017, 2018. Well, what the heck, right? We've got some crazy years in here. Some atypical earnings. And we'll get to why that is in a bit. Okay, so let's just keep moving on for right now. All right, so when we went back for a second, I just want you to take a look at these crazy numbers down here. What are these crazy numbers about? Negative, positive? All right. What happened is if you come on over here and you look at their net earnings for 2018 or 2017 really, they were at 3,000, really millions, right? 3,447, and then they dropped down to 2,000, and then they're back up to 4,200. So like, what the heck, right? Why that shows that huge percentage swing. Well, if we look at what happened in here, I mean, if you just went from 2017 here, 3,447 to 4,281, that seems like a reasonable increase. But I'd look back at this 2314 and be like, well, what happened in 2018? What happened in 2018 was they had a huge amount of selling general administrative expenses, right? They went from 14,444 to 17,413, back down to 15. So whatever they did in that year, they impacted their end numbers pretty significantly. Does that mean the company is doing poorly? No, maybe they had some big write-offs that year for some reason. But yeah, so that's, when you look at it, these tools that we're using are highlights. They go, hey, something weird happened here. You should look at this number, right? And that's what that crazy percentage tells you. All right, before we get into vertical, well, we can do vertical real quick. Okay, vertical analysis. The idea with the vertical analysis is the sales number is always 100%. So you're saying, of the overall sales, what is the percentage of cost of sales? What is my gross profit percentage? How much of my selling general administrative expenses how much are they as a percentage of sales? So sales is your bottom line number. That's your denominator, your 100% amount. So if we went over here, we're going to grab this sales number here, this 110,225, and that's going to be our denominator, and that's going to be the percentage of everything. So if I want to know my cost of sales, there we go, 72,653 divided by net sales. So my cost of sales, well, there you go. My cost of sales is 65.9%. That means of my, of $1 in sales, it cost me almost 66 cents to purchase the item that I then turn around and sell, which then means my profit percentage, my gross profit percentage is 34 cents. And that's a pretty meaningful number, because what that means is for every dollar in sales, 34 cents of it is profit. All right, so you're going to grab the other numbers off of there, and you can always put them over the 110, 225. So just grabbing all these numbers from right here, right? Operating expenses was 21,729 and so on. And you can grab all those other numbers, throw them in here, and you'll see how they did. So this is what we've done here, is we've done a common size statement. You could look at them on their own, Home Depot, from one year to the next. Or when you have companies of different sizes, it's really helpful to use this as a tool to compare those companies. You say, look at Home Depot. They managed to keep every 34 cents of every dollar they sell, whereas Lowe's only gets to keep 31 cents of every dollar, or 32 cents of every dollar they sell. Or their selling expenses. Home Depot has far less selling and administrative expenses. Lowe's has pretty high ones, right? 21.3%. So we don't know what the dollar amounts are, but we can compare their percentages. And that's something that's really helpful with the common size statements. So at the end of the day, these kinds of discrepancies mean that of overall, Home Depot keeps 14.4% of their operating income, or 14.4% of their sales, whereas Lowe's only keeps 8%. Okay? All right. So I'm going to start the next video in just a second, as soon as I figure out how to stop it.